Welcome to Two Quants and a Financial Planner, where we bridge the worlds of investing and financial planning to help investors achieve their long-term goals. Join Matt Ziegler, Jack Forehand, and me, Justin Carbonell, as we cover a wide range of investing and planning topics that impact all of us and discuss how we can apply them in the real world to achieve the best outcomes in our financial lives.
Justin Carbonell and Jack Forehand are principals at Validity Capital Management. Matt Ziegler is managing director at Sunpoint Investments. The opinions expressed in this podcast do not necessarily reflect the opinions of Validity Capital or Sunpoint Investments. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validity Capital or Sunpoint Investments.
So we're continuing with our theme of ETFs. Last week we talked about the small cap value ETF that we ran, and I think listeners got some value from that and hearing the story and sort of the nuts and bolts of how sort of ETFs launch and operate, and then subsequently for us wound down. But what we wanted to do today was talk about how investors might look at analyzing ETFs and all the different, particularly active ETFs, and all the different things that an investor might want to look at. And we're going to go through a whole bunch of stuff, everything from why you would consider these ETFs to whether or not the ETF strategy makes sense, to the issuer, to the underlying sort of holdings and how an investor might be able to look at various ETFs and sort of judge them on a number of different sort of factors or ways. And towards the end, we'll actually use a tool that's on Validia, the ETF Factor Report, and we'll look at some ETFs specifically to, I guess, compare and contrast, different ETFs that would be considered somewhat similar in terms of their style, but how they can actually look very different. So hopefully you guys hang around and watch us sort of work through that tool, because you can actually access that tool on Validia. I believe it's free, right, Jack? That's in front of the paywall,
free.
Right? Yeah.
Yep.
So, hopefully you guys can use that and get some value out of it. So, but let's just start, Jack, to set the stage. Let's talk about the difference, and Matt, talk about Matt's here too, everyone.
Glad to be here.
Talk about the differentiation between factor ETFs and what would be considered like active strategies.
Yeah. So taking a step up, the first thing we're going to talk about active equity ETFs here. And you'll see a lot of times like classifications of ETFs as either passive or active. For the purposes of this discussion, you should throw that out, because what we're really talking about is the ETF different than its benchmark? Is it trying to outperform the S&P 500 or the Russell 2000? You can have active ETFs that are technically classified as passive, and we're going to still consider those active ETFs for this discussion. So we're really looking at something that's different than the benchmark. And to your question, like if I want to be different than the benchmark, there's kind of a couple ways I can do that. One is you've got your traditional active management that's been around forever, which is, Matt's stock picking fund. Matt is obviously an incredible stock picker, very long-term track record. Yeah, I mean, very, very good. No down years. Matt is the exception to the rule when it comes to, people who are trying to pick stocks themselves. Most people have underperformed that way. So that's kind of your active, but then you've got your factor ETFs, which are also active. They can be very, very different than the benchmark, but they're trying to do it in some sort of systematic way. They're trying to use value or quality or momentum or something like that. So we're going to talk a little bit about both here, but I think it's important to differentiate the two. Because active management has a pretty bad rap, and it's justified. If you look at mutual funds, I think something like 90% of mutual funds underperform their benchmark over like really long periods of time. So, and fees are the big reason for that. So it's important to understand that. But by the same token, factor ETFs are a little bit different than that. Factor ETFs are using something that's tested over a really long period of time. Factor ETFs typically have a lower fee than an active manager would have. So we just want to differentiate those before we got started.
I think the other important point here before we dive into this is, ETFs have become much more popular among individual investors, among financial advisors. And there's, on the equity side, I want to say, and I might be somewhere, I think there's somewhere between 1,500 and 22,000 equity ETFs, last time I checked. So the point in talking about this is, it's important to have, with all these different options out there, Matt, you're looking at ETFs for your clients. We invest some of our clients in ETFs, but investors have all these choices. And so trying to have a sort of systematic way that you're looking at and reviewing and finding these ETFs and making these selections, I think is important. It's not like there's, a handful of ETFs. It's like it's proliferated and it continues to grow the market. So let's talk about the importance of a system to evaluate it and why that is. In addition to just the pure numbers out there, I mean, we got to think about a number of different things. So let's start with like, I guess, the area of risk and return and what you're looking for. So, I don't know, Jack, like, certainly you want to look at risk and the level of risk within these ETFs, correct?
Yeah, just back to your other point. One of the cool things about there being so many ETFs is like whatever you're trying to find, you probably could find it. The hard part about it is what you said, which is trying to sift through everything to come up with the right thing is very hard. But it's great. There's been so many new strategies that have come out in the ETF world that like no matter what you're looking for these days, even like hedge fund type strategies, which we're not going to talk about today, it's all out there now. And if you're looking for a value ETF that meets your criteria, the odds are there's one out there. There's a lot of value ETFs. And so it's more like figuring out among all those value ETFs, what's the right one for me. And so we were just listing some criteria that you might want to look at. And, one of the things is you want to understand like when it does well and when it does poorly. Like what are the risks of this ETF and sort of what is the return profile? And that's important because if I'm looking at a very, very focused value ETF, that's going to look really, really different than a value ETF that just slightly, changes the weights in the S&P 500. Those are going to be two very different outcomes, and the returns are probably going to be different over time. The risks going to be different, and most importantly, behaviorally for me as an investor trying to follow it, the one that closely tracks the S&P 500 is going to be a lot easier to follow than the one that's very, very focused. And we're going to look at some data around that later. But I think those are the types of things you want to look at. And Matt can probably speak to the next one, which is the idea of you've got to look at this in the context of what you're actually trying to accomplish. You don't want to just say, oh, this is a cool ETF. Let me just throw it in there and throw it together with my other 27 ETFs. Like it's got to be part of a plan for it to work.
I think the allocator perspective, which is really important on this, because I think this is where I'm going to call this like a retail mistake, but I think we see this in maybe not so much in like very formal institutional settings, but we definitely see this in other advisor portfolios, is you're thinking about the portfolio in total. So you're thinking about how do all these managers, how does all this stuff stack together? And at each layer, you're picking, do I just want beta? Do I just want pure index exposure in this sleeve to give me my domestic large cap equity that I've decided should be this size in my total portfolio? And then inside of that, when we get into risk metrics and everything else, how much different am I willing to look from just that pure beta, just that benchmark, just that thing? And then what's the reason for it? And what's really important is allocators, good allocators will think in this great big puzzle together, because sometimes two things in two different places might be related or correlated, and they might have relationships to each other that we want to try to understand and then take deliberate risks. Because the overarching theme of all these conversations is the strategy is only as good as your ability to stick to it and get what you think are the advantages or the edge over time. So when we start to think about these active ETFs or active vehicles and where to put them, we're thinking about exactly how do they fit in, how do they relate to everything else, and why behaviorally is something in our process in alignment with what this thing represents.
And it's so it's amazing how often you don't see this process go on, both, by the way, with individuals and financial advisors to some degree.
100%.
Like my family all the time, they're like, oh, I bought this random oil stock. Well, how does that fit in? Like, there's literally no strategy whatsoever behind it. There's no thought of how does this fit into my portfolio? It's like, oh, I thought the oil stock was going to go up, so I bought the oil stock. And like Matt, also, you see all the time, you see it on Twitter like I do, like someone who will inherit a portfolio from another financial advisor. And it's just like 63 mutual funds that have nothing to do with each other, that make no sense together. But somebody like an advisor was just buying up stuff basically to look like they were busy or something like that. So it's amazing how often this doesn't happen in the real world.
Yeah, without any overarching theme. And if there's one thing that I've learned in my professional experience, it's just find that overarching theme and figure out how to either have that, ideally, have it reflected both by the clients and then something I talk to other advisors about all the time. I think I've said it here before. There's this whole thing of, it's like the idea that, I'm thinking of old Looney Tunes episodes where it's like the people look like their pets. So it's the idea that this guy looks like this dog that he's walking down the street or whatever. And advisors and relationships and investment strategies should all kind of follow the same logic. Like you should kind of look like the thing that you're trying to embody. It should be intertwined with you. So And maybe this is why this happens. People who are all over the place end up with an advisor who's like, this week I want this oil stock, and next week I want to be short uranium or something, and whatever the hell happens in some of these portfolios that hit our desk. But what we're always trying to do is it's like for us, for my job, it's most of the people I work with, they understand like quality, they understand durability, they understand profitability in some way. And it's like, let's pick managers, let's pick strategies, let's pick occasionally individual investments in the portfolios we build that reflect all that stuff. Because that's the way when the stuff is hitting the fan, or we're trying to figure out if something fits or doesn't fit with the strategy we're putting out there, that we can go, does this fit with not just like a value portfolio, but with our values, so we can stick with it for a long time. And that's huge. What a simple idea, but it keeps you away from mutual fund salad and some of the disastrous portfolios I've seen over the years.
Super important stuff. I think where we're going to go is in looking at ETFs individually, but to the point you guys both made, for hopefully most people, it's much more in the context of an allocation or matching it up with goals and behaviors that people sort of have. And Matt, you talked about this a lot in many podcasts with, how you basically work with investors. But I think in terms of evaluating individual ETFs, just a couple things out of the gate. ETFs are super tax efficient. They tend to be lower cost. There is transparency into their real-time holdings or daily holdings, and they trade on exchanges throughout the day. So those are all the benefits of ETFs. People that invest in ETFs mostly know that, but for anybody that's new to ETFs or doesn't invest in ETFs, that at a high level, those are the things that ETF investors get sort of the benefit of, I guess. But in terms of, does the strategy work for you or is it sensible? I think that's sort of the first point, right? In evaluating any ETF is, do you understand how this portfolio is being constructed or what it's trying to exploit in the market? And does it make sense to you? If you go to an ETF page on the, some issuer site and you're not really understanding the strategy, but it has great performance, then, I would say that strategy probably doesn't make sense for you because you should really be understanding what you're investing in. So I think that's the first point. You guys mostly agree with that?
Yeah, and there's a couple of ways you can get at that. One is there's prospectuses for ETFs, and they do explain the investment strategy. So you get some idea from that, what they're doing, and then you compare that to what they're actually doing. So the cool thing about the ETFs is they have to disclose their holdings every day. And so you can not only see what they're doing holding today, but you can see what they've held historically. And so you can match that with what you saw in the prospectus. Like, are they actually doing what they said they were going to be doing? And so with quant ETFs, like with factor ETFs, that's a pretty easy process. It says it's a value ETF. Let's go to these tools that are available on the internet. Let's see if they're buying value stocks. Let's see, how they're going about buying those value stocks. Is it focused? Is it not focused? All those criteria. And you can really have a very good understanding of what you're getting, which is the cool thing about ETFs, maybe a little bit different than mutual funds, which are reporting delayed holdings. You can see in real time what they're actually doing.
This idea that active manager, active ETF analysis, it's an alignment exercise, both alignment as the end investor or the allocator in the strategies or the behaviors that we want to have in creating the bigger portfolio in this one sleeve, and also to make sure the manager is in alignment with the thing that they say they're going to do. ETFs tend to be a great wrapper to analyze this because it's not a black box. To your point, the holdings are transparent. If somebody says they're a value investor, we can pretty quickly look at the holdings and say, this checks out. And that's a really powerful tool for investors and allocators to be able to understand, does that alignment exist at all the layers of our analysis?
I had a client about a month ago send me like a list of 20 ETFs that he was invested in. And there was the broad market-based ETFs, there was growth ETFs, there might have been a technology ETF in there. And he had like some mid and small cap stuff represented too, but I went to each of the, because he wanted me to look at those and he kind of wanted my feedback on them. And so I would say of the 15 or so ETFs, about half of them were basically like market cap weighted. They were basically duplicating each other because, if you're investing in the S&P 500 and NASDAQ, I mean, it was all like tech heavy heavily weighted. And so there was so much overlap in between strategies. On the surface, they looked like, based on the names of the ETFs, that they would actually be different. But when you looked underneath the hood and at the holdings, there was tons of overlap in there. And so I think the thought to him was, you might be able to call down on some of these and consolidate. I don't ultimately know what he ended up doing, but he, was asking for so that's another thing that the holdings allow you to do. If you're invested into ETFs, you can say, okay, well, what's the overlap here? How similar or different do these look? And are they helping me kind of accomplish my goals here? So
yeah, it's cool. There's a lot of tools, not just our tool. There's a lot of tools that allow you to analyze the holdings these days. And there's also tools that allow you to analyze the return streams, like Portfolio Visualizer is a great tool. You can actually look, when you have a portfolio like that, you can actually put those things together. You can see the return streams. You can kind of see, if I'm looking at a different ETF, what is it adding? What is it subtracting? Is it very similar to one of the ones I already have? You can look at it in both ways, both from the perspective of what it holds, but also from the perspective of what the historical returns have been and how it fits into the other things you're doing.
Understanding how all those sleeves stack up, and there are tools for that, and Portfolio Visualizer, a lot of like BlackRock has Aladdin. There's tools that are out there that help advisors and allocators and some individuals to assess this stuff. Because this is what we really want to understand. We want to understand, am I taking enough active tilt in the construction to basically earn more than the fees, at least in theory? And am I accepting the right amount of variance to do that? Not for stupid reasons, but with intent, in a way that I can stomach the ride. Otherwise, I can't tell you how many times looked at a portfolio and basically said, you basically own the market. You got there in the most complicated and expensive way possible, but congratulations, you could have bought one ETF.
By the way, that's one of the big wins here for investors, is that, the ETFs complex has certainly put compression on fees. It started with passive market cap weighted indices, which you basically effectively buy for almost free now. And then, even the active strategies, we see these issuers who are, lowering their fees, or the fees are certainly reasonable. Forget the years of the, 1.5%, 2% expense ratio. They're still out there in the mutual fund world, but in the ETF world, that basically doesn't really exist. But let me ask you, Matt, I mean, how do you assess when you're looking at ETFs for your clients? How do you kind of view the fees? Is it just sort of what you said? Like if it's like broad-based, passive exposure, you want the lowest fee possible. If you're getting something active and unique, you're kind of willing to pay more. How do you guys look at it?
Yeah, so the fee has to be, you have to have some justification on why the cost that you're adding gives you, at least that's ideally more than that size of advantage for what you're investing in. So if I'm a large cap growth manager and all I do is own market cap weighted large cap growth stocks, and I'm no different than the benchmark, well then just go buy an ETF for a couple of basis points that tracks the same thing, if you don't want to just go out and own the individual stocks outright at no fee. Now, on the other hand, if there's a trading strategy, a valuation overlay, something, and we can look at it and go, hey, look, it shows in the data that this process has basically created more value than it costs, then we want to look at it. There's not a lot of examples of where this bears out, especially in the large cap equities space, but they are there, and they're worth looking for. They're worth understanding. And then they're worth understanding, is the ETF the right wrapper for it? The counter examples are when we look outside of, when we look into private markets and other places, that's where we can get into a much more deliberate conversation about, do you create more value than you cost? And we can see where's something that you might not be able to go out and do on your own. But especially when we're talking about public, large cap stocks in particular, just about anybody can do this stuff. So you better have something in your formula that is worth more than your fee.
And fees are really, really important. Paying a higher fee much of the time does not work out, but it's also important not to go too far with it. So if you're analyzing two value ETFs, and you're like, I really like this one over the other one, but one's charging 13 basis points and one's charging 14. So I'm going to go ahead and use the one that charges 13 to save the 1 basis point. I mean, you see stuff like that where you take it a little bit too far. If you have to compare the value I'm getting and how much I like the product relative to the fees. And, a 1 basis point fee difference is not going to make much difference in your long-term financial future.
People misunderstand, I think, misrepresent the role fees play. And that's the best way that I try to help explain this to people is it's about the cost versus the created value. And that created value doesn't have to be realized in a single calendar year or in a single trading day. But we have to understand, why do we expect this thing to create more value than it costs and why? And it's okay. You can have something that's quote unquote expensive or more expensive, but if it creates more value than it costs, it's worth paying for.
So we talked about, does this strategy make sense? We talked about, you can look at the strategy and see what the ETF holds. Fees are obviously very important. Then there's this idea of, do you actually trust the issuer, the firm that's bringing you the ETF? Obviously, Vanguard, BlackRock, Fidelity, Schwab, they all have
Lydia
ETFs.
Capital.
Oh, there you go. Yeah, I mean, so it's like you have the large issuers, and I think they carry a lot of trust. And then there's a whole cottage sort of industry of smaller ETF issuers. We were one of them at one point. And there's a lot of, innovative, interesting, good strategies that are sort of coming out. But I think it is, for the investor, it's like you can go to these issuer websites, you can read about the team, you can learn about the investment process. Is it sound, and then kind of start to develop, I think, a level of trust and understanding of who the issuer actually is behind the scenes. And what I would say is, because in the ETF business, you have like white labelers and sub-advisors, and, it's not always what you think you get on the surface. So sometimes you do have to dig into the prospectus to really see kind of who is behind this. And those prospectuses are so dry. And oftentimes that kind of stuff is buried like on page 23 somewhere, in like a table or something. So, but it will always be there. So I just think, having sort of a level of understanding of who the issuer is important.
Yeah, not just issuer, but all those things you listed. Because one of the things you said can be really confusing to investors is you have issuers who issue ETFs. You have advisors who run the strategy. They can then use sub-advisors who are actually the one running the strategy. You can have index providers on a passive ETF. And so like there's two different things you want to understand, like who's issuing this ETF? Do I trust them? And like we talked about in our last episode, ETFs get, we had to shut an ETF down ourselves, but it's not just small issuers that shut down ETFs. Like BlackRock and all those places shut down ETFs all the time too. So even if you trust BlackRock a lot, it doesn't mean your ETF's not going to be shut down, but it does mean, no matter who the issuer is, your money's going to be safe because of the process and behind ETFs, no matter who issues it, if it gets shut down, you're going to be okay. But the bigger part, I think, is who's running the investment strategy. Do I trust them? Do I believe in them? Do I believe in the strategy they're running? And figuring out, like you said, who that is can be a little bit challenging. Is it the sub-advisor strategy that's in there? Is there an advisor? Like there's all that stuff, all these different terms getting thrown around, but whoever's running the strategy, do I trust them? And if they're a quant investor, do I trust their process behind the scenes? If they're an active investor, do I trust them specifically? But just figuring all that out is really important.
Figuring it out and knowing how to ask the questions to the right person to ask the question to, which sometimes can be a challenge. We've definitely vetted some active ETFs before, and like figuring out the decision-making chain of command for exact processes sometimes, you'd be surprised how many people you have to ask till you really understand how certain decisions are getting made. Because kind of to Justin's point, yeah, it's in a table on page 23 of the prospectus, but sometimes you actually need a human to translate that for you. And you have to talk to 5 people inside the organization before they can say, well, this committee makes this decision, but it's only done on this day of the month. So if this thing happens, then this committee's not going to get around to rule it out. And man, I've watched Lee, my director of research, go through this more than once. It's out there.
I wonder how much investors kind of shop around and compare. I mean, I would think probably more, I'm not individually out there buying ETFs, but I'm, on most of these brokerage sites, you type in a ticker symbol, it says small cap value ETF, and we actually do it on Validia too. We show you comparable ETFs that look similar based on some type of analysis. It might be a holding analysis. Usually that's what it is if it's an equity type thing, although it might be a return-based one too, correlating the returns. But it's just an interesting question around, you're looking for some type of exposure and then how much comparison is being done. and sort of, and I guess, we'll look at that in a minute, because we're going to compare some of these ETFs in a few minutes here, but I don't know. I'm wondering, like, if it's investor gets an ETF in their mind and they're like, I'm buying it, or how much, comparison is being done among ETFs.
I know for us, SunPoint will have a topic or an idea or an expression for something come up in our investment committee, and that'll spawn the conversation of all the layers. Is there an index that tracks this? Is there a passive index that we can invest in that expresses this idea? Are there active variants of this? Are there public and private market options for this thing? What do they all cost? What do they look like? What's the size of the risk? What's the size of the conviction? How should we think about putting this on? And if you're really doing this and not just saying, I saw a cool sounding thing online or on TV, you're probably taking all these considerations into question and asking all these layers for different ways that people can do it. Because that's part of understanding, again, the alignment you have as the investor or allocator with the managers in your stable inside of your portfolio, and then those managers' alignment with what they're doing, and do they create more value than they cost?
So let's step into all the different variables that an investor could look at when evaluating an ETF. Now, before we do this, what I'll say is that this discussion could be around any investment equity portfolio, whether it's a portfolio of your own, whether it's an SMA, whether it's an ETF, whether it's a mutual fund. I think all of these are going to be applicable to any portfolio. We're using it in the context of an ETF wrapper because of all the benefits that ETFs have, which we already talked about. So the first most basic probably thing is, how many positions does the portfolio or ETF have and how many holdings? So just to contrast, you have market cap weighted indices or firms that kind of tilt or do some fundamental indexing. So there's a whole span of how you can get exposure to these indexes, but they will hold hundreds or thousands of securities. Then there are more focused ETFs that may hold anywhere from 30 to 100 securities. And then there's stuff in between there. If you're trying to maybe carve out, of the S&P 500, the best fundamental firms based on some different type of metric. So you have all these different kind of groups or classifications in terms of the number of holdings. And that kind of gives you a starting point to just understand, okay, is this portfolio giving me broad-based exposure to some area of the market? Or are they really trying to be active and, I guess generate alpha?
Yeah. And I would group, like, how do you weight the holdings in the same bucket here, which is, I'm starting with my benchmark, the S&P 500, the people are going to compare this portfolio to, or maybe the Russell 2000, but we've learned in the real world, most people are comparing almost everything to the S&P 500. How am I different than that? And so if I have, we're looking at this ETF here, which we're going to talk about in a minute, but 51 holdings is very different than 500 holdings. And also, if I'm looking at a broader universe of mid that includes mid cap and small cap stocks, the universe is also much bigger than 500 stocks. So those 51 holdings could look, those could be the same 51 stocks that are the biggest stocks in the S&P 500 market cap weighted, in which case doesn't look that different than the S&P 500, or they could be 51 small cap stocks, in which case this portfolio has, very little to do with the S&P 500. So there's obviously some digging deeper, and we're going to talk about active share in a little while, that has to go on, but like the number of holdings is a good starting point in how they weight the holdings. Just thinking about, again, knowing we're all going to compare this to some degree to the S&P 500, how different is what I'm getting from that?
And never forget, in its simplest form, the fewer things you own, the more exposure you have to the individual company risks. So understanding less holdings, more exposure to company risks, you're probably going to look a lot different than a benchmark. And one other point of nuance in there is understanding what's the weightings. So in this case, 51 holdings, if that's what we're going to talk about first in this fund, understanding, are they equally weighted? Are they market cap weighted? Are they valuation weighted? What metric is deciding how much of something is in, whatever the number of holdings are present?
One of the things that you'll find on almost every ETF fact sheet is what size and style. But for this point, we're going to talk about the size. What size equity strategy is it invested in? And that's, the Morningstar size boxes. So small cap, mid cap, large cap, mega cap. Mega cap might not be a box in Morningstar, but there are mega cap companies out there, the very largest maybe. But so I think understanding, what size the ETF is playing in terms of stocks is important. But Jack, let me ask you, I have a portfolio of 10 stocks. I have Apple and Microsoft, and the other 8 stocks are all small caps. I want to use the average market cap, right?
Yeah, no, you definitely want to use the median. But that's also, that's a really important point. And it's why we put both on our report here is they both kind of tell you something different. But like you said, 9 stocks plus Apple, 9 small cap stocks plus Apple and 10 small cap stocks could have the same exact median market cap, but the mean is going to be way more. So it's important to look at both, I think. I mean, I think the median is more accurate in a lot of cases because it sort of represents the broader portfolio. But you also want to understand, like if you're buying a 10 stock portfolio and one of the 10 is Apple and the other, you want to understand that. So if you just looked at the median, you wouldn't know about the Apple part about it. So we look at both and you can see they can be very, very different numbers. Like here, one of them 17 billion and one of them's 100 billion. So it's a big, big difference on smaller portfolios, especially, where one big company can have an outlier effect. But it's important to look at both because it just gives you an idea of, does this fund own both small and mid cap stocks? What in terms of like how many, are most of them small cap stocks, or is it with a few large cap stocks, or is it broad across the spectrum? Like these two numbers can give you some ideas on both of those areas.
Matt, do you know, in terms of like sector exposure, are there, and maybe, because I'm not sure if Morningstar reports this, but I was thinking like, obviously understanding the ETF sector exposure is important because if it's, more heavily weighted or underweighted in a specific sector and that sector does good or bad, that's going to obviously have an impact on the overall performance of the strategy. But a sector, the sector exposures are like point in time. Is there any, do you know, does Morningstar report like historical sector exposures, or have you ever seen that? Because I think that would be maybe a little bit more relevant than if you're looking at a fact sheet and you're saying, okay, here's the sector as of 12/31, but obviously as the portfolio is changed and updated, especially with more active ETFs, those sector exposures are going to change over time. So maybe like a historical sector weighting would be more relevant, possibly.
So I believe in one of the bigger Morningstar reports, you can run that. I know through some of the other tools that we use, you can run that. Okay. Normally, if we're looking at this, we're looking at a fund or a manager, and we're trying to understand, is security selection driving, ideally alpha, but like ideally driving the difference in the return stream from the benchmark? And typically, rule of thumb, the more securities you see, the more the security selection actually reduces to sector bets. And if it reduces to sector bets or sector rotation in some way, then we want to understand what that contribution is over time. So usually you're going to go direct to the provider and you're going to try to ask in your due diligence process to get this data and understand where the source of that advantage is coming from. Case in point, an example might be like years ago, looking at a lot of like the ESG strategies for clients when this would come up. And you'd go, especially in a post-financial crisis world, there was this window of time where just not really having banks or energy. So a sector bet equated to a lot of outperformance. And you wanted to know, okay, this isn't about security selection. This probably isn't about ESG factors. It's just about these two sectors were underweight in these portfolios. You were overweight tech. And that's why this worked out so well in the sample period when we do the look back. Teasing that apart, if it's security selection, a sector bet, some combination of both, relative to your benchmark, is again key in understanding the investor or the manager's alignment to their strategy, and then you as the investor or allocator, your alignment to how this is going to fit into that sleeve. That data's out there. Sometimes you have to dig for it.
To your point, Justin, looking at this one here, like there's a significant overweight of capital goods. To me, the willingness to look different is what I take from this. Going back to the same thing with the holdings, like these are all pieces of a puzzle that say, is this portfolio willing to look different than its benchmark? Because to your point, like this overweight, especially for a momentum strategy, this could change, tomorrow. This could be completely reversed, like this entire thing, because that's what momentum is. I mean, momentum just finds momentum wherever it exists. So like trying to say like I should learn something from whatever the overweight sector is here is probably useless, but it is valuable in terms of realizing like the total picture of, is this ETF willing to be different than the market, and how different is it willing to be? That could just be another tool in the toolbox of figuring that out.
This next one, I'll let you comment because I got in trouble with it on YouTube when I was talking about our ETF rebalancing frequency. and how I said, what was it? And then most clients liked it. So I'm just going to say the next point, rebalancing frequency. Go, Jack or Matt.
Yeah. And also, by the way, hard to find. You won't find it on our report. It's usually in the document somewhere. But, most reports you're going to pull up on an ETF are not going to tell you how often it rebalances. And, for many investors, this might be a little bit too in the weeds. But it's important. It's like we're looking at a momentum fund here, using momentum as an example. Like momentum is something, if you rebalance it more frequently, does better. So if I've got a momentum fund that's rebalancing monthly, which I believe this one is now, and I've got a momentum fund that's rebalancing once a year, well, I probably want to favor the one that's rebalancing monthly because momentum changes and I want to continue to have that exposure to momentum. So those are the types of things that, maybe with like an active manager where someone's picking stocks, this is not a relevant thing. But for factor funds, it can be a relevant thing depending on the factor you're looking at.
And at risk of getting Justin on this, there's rebalancing, which is inside of the strategy. And then there's reconstitution, which might go hand in hand with rebalancing, but is a different thing. And you gotta understand both at the layers that the ETF operates.
Yeah. So just let's flesh out reconstitution. Reconstitution is when new, like for the S&P 500, new companies come into the index and companies get removed from the index, where rebalancing is just bringing the portfolio or bringing a sleeve of the portfolio back to some, I think, weighting that the manager of the strategy is trying to achieve.
Right. So think about like if I have the S&P 500 before Tesla gets added, Tesla's not in the index. So as a manager of an S&P 500 fund, which doesn't really have to do anything in the cap weighted sense, like say a company goes bankrupt and basically gets flushed out of the index just because the shares are no longer trading. Well, it's new dollars coming in, there's new creates or redeems, like that shadow ticker might still be like living in the fund itself. But when Tesla gets added, that's a reconstitution event. Now we have to like reconfigure the weightings and the other holdings of everything's there. There's a new creation and redemption process, if you will, around that addition on the day that starts trading. So you could have events that you have a reconstitution of who's included in that index, and that can have an impact on the rebalancing process. The more active ETFs, especially with more active benchmarks that they're tracking usually, you want to understand that reconstitution process as well as the rebalance process, because that's the difference between a value fund might be selling the expensive stuff to buy more of the cheap stuff, but then reconstitution might say, we're removing some of this expensive stuff from the list. We have new cheap stuff adding, and we have a whole new sleeve of things we're going to own.
Yeah, like a lot of us in the industry tend to use rebalancing as like a shorthand for all of that process, but you're right. I mean, that technically there is a difference there. Like we use rebalancing to say we're bringing stocks in and out, but you have to be careful about the terms basically, because somebody might be using it in one way or somebody might be using it another way.
And that gets back at the heart of in truly active things, there might be really rigid processes about how stuff comes in and out and the timing of when it comes in and out. And that can have a big difference because that can be the type of stuff we see this the most. Like always think of the junk bond ETFs. So it's like you have a junk bond ETF. And I remember when like all the coal companies were going bankrupt and it was like, this fund has a 10% sleeve and a defaulted issue. And it's like, well, why? Why don't they just rebalance out? Why don't they just do it? It's like, well, no, the index reconstitution date says they have to hold this thing for the next 3 months or 6 months or quarter or whatever it is before this thing can get flushed from the index itself. And in the meantime, it's just like a shadow piece of dead weight in all the existing portfolios. You want to ask these questions and understand this process because it can actually be a limitation on something that doesn't just have an open throttle to just say, oh, something changed in the world, I'm going to change that today. An active mutual fund might be able to do that. An active ETF may not.
One of the big differences with ETFs is you can trade them throughout the day. And so there's a certain amount of trading volume that is displayed when you go to buy it or on Yahoo Finance or wherever you're looking. And, particularly we went through this as a smaller ETF issuer. There was question or concern around, well, how liquid is this ETF? If I put $100,000 into it, and it doesn't have very much volume, is there going to be some issue with that? Or am I not going to be able to get my money out? And so I know we want to hit on this liquidity piece of it, Jack, which I think is important.
Yeah, this is really important. We should have talked about this in our last episode as well, but the idea is there's two important points of liquidity for an ETF. There's the liquidity of the underlying holdings, and then there's the liquidity of the ETF itself. And a lot of people in the ETF space will say, well, all that matters is the liquidity of the underlying holdings. And they're correct to an extent, but they're not really correct. And the reason is because, like, using our ETF as an example, we would trade, hundreds of shares, thousands of shares a day, not much more than that. So what happens is the market maker does not have that many resources allocated to our book at any given time. And so what would happen is, let's use Matt as an example. Let's say Matt wants to take 1% of the Ziegler fortune, which we'll estimate around 10 million. Let's say Matt wants to take that 10 million. Okay. He wants to put that into our ETF. If he had just gone and said, buy market our ETF $10 million, the price would have gone up exponentially, even though those holdings behind the scenes are very liquid, because there's not, the market maker does not have resources allocated to it. And so in our case, what people always say about ETFs is, you almost always want to use limit orders. Obviously with SPY and stuff, it's not a big issue, but with smaller ETFs, you almost always want to use limit orders for that reason. You can eliminate the possibility of a bad execution. But also, like, when we were behind the scenes with the ETF, we had the ability, if we knew a big order was coming in, we wouldn't tell the market maker the direction of it, whether it's buy or sell, but we would tell them it's coming in, and they would expand the book. So that there's tools, if you're working with somebody who issues an ETF, and you're putting in a big order, there's tools where you can work with them to get it done properly. But the limit order is the easiest thing, but it's just important to understand that their liquidity is an issue with these things. And if you have to understand liquidity on the execution side, and if you don't, you can end up with, well, I executed 7% above what the NAV of the ETF is because I put in this massive order that was way bigger than the average daily volume of the ETF.
And this, especially for allocators and advisors who may be, we might be trading inside of a model that owns an ETF for a ton of clients. So it could be a sizable order. We're going to coordinate that with a trade desk at our custodian to basically say, here's the size of the order we're doing. We don't want to move the market. Are there creates and redeems that we want to be a part of or piggyback onto? And there's a whole process that goes on behind the scenes. So it's very different if you're trading, a share here and there of the S&P 500 ETF versus if you're trading an issue, understanding how liquid or illiquid it is, and then the layers depending on your size that you might jump through to make sure you get good execision. And you don't shoot yourself in the foot right from the get-go, from the entry or the exit, which you can do.
And limit orders can be annoying. I know, I always hate the thing, I don't use limit orders very often, but I have had times in my life where I have, and you're always put it in and the stock moves up above your limit order, and then you got to reset the limit and you got to do it again. But that's less annoying than, getting executed 5% above the actual value of the ETF or something. So it's just a better way to execute on the ETF side. And then when you're dealing with smaller ETFs, it's a good best practice.
So far we've talked about, I think, excluding liquidity, we've talked about things that are pretty easy to understand. I mean, number of holdings, sector exposures, the size that the portfolio is, mostly playing in, the rebalancing frequency, although like you pointed out, Jack, that's kind of hard to uncover sometimes. But this next concept is kind of getting a little bit more advanced in terms of how someone would analyze the holdings of an ETF. And that's something known as active share. And my basic definition of active share is how different is the portfolio or is the ETF from the benchmark, whatever benchmark you're looking at, whether you're looking at the S&P 500 or Russell 1000. But when you start peeling back, I guess, the layers of what goes into active share, it certainly becomes a little bit more of a advanced topic. And it's not something that all investors look at or even really understand what's going on. So let's just flesh that out a little bit more here.
Yeah, like you said, I mean, it really is how different are you than the benchmark? And it's important to understand, this is not just an S&P 500 thing. You can do an active share against any benchmark. You can do the calculation. And, I don't want to put our users to sleep. And if I brought up my spreadsheet and we actually did the active share calculation right now, I think that would be the end of anybody listening to this podcast. But the idea is, it's something that ranges from 0 to 100%. If it's 100%, I'm completely different than what I'm comparing myself to. If it's 0, I am the thing I'm comparing myself to. And it really is a function of two things. Do I own the same stuff as the benchmark I'm comparing myself to? And how do I weight them? So for example, if I have a small cap value ETF and I do the active share against the S&P 500, it's going to be 100%. The reason is because there are no small cap stocks in the S&P 500. So I have nothing in common with the S&P 500. On the other extreme of it, there used to be, and I don't think it exists anymore, but there used to be a reverse S&P 500 ETF. which would effectively weight the small caps more heavily in the S&P 500. That ETF would have the exact same holdings as the S&P 500, but would still have very, high active share. And active share is something that it's controversial because it's not, people tend to knock it because it's not good in and of itself. Like just because something's different doesn't mean it's good. So if Matt is running, if you and Justin are both running a factor ETF, Justin's running a thoughtful multi-factor ETF, and Matt says, I want to take high debt companies that are about to run out of cash, and I run that ETF. Those two ETFs could have the exact same active share because they're both very different than the benchmark. But the reason behind the active share is a good reason for Justin's and a terrible reason for Matt's. So on its own, active share doesn't tell you anything. And actually, by the way, Matt, yours probably would have outperformed in the past decade compared to Justin's, which is
I'm the one printing money here.
Right, exactly. Yours probably would have worked out. We could pull up ARC's factor report right now, and you would realize that's worked actually a lot better. But nonetheless, that's the idea. Is like it tells you how different it is, which can be very important behaviorally. But it has to be coupled with other variables, which we'll talk about in a while. Like to have any value, it has to be put together with some other variables as well.
Yeah, because you can look different, and sometimes that's just because you have the wrong benchmark. So it's like you could have high active share, but it just might be I'm measuring you against the wrong thing. I've got some like junior gold miners thing, and I'm measuring it against the S&P 500. Oh, high active share, totally wrong benchmark. And it's a useful tool. It's a ruler that you want to have, but you want to understand when you're using it. It's not a be-all, end-all solution to everything.
The Ziegler fortune actually came from Matt's buying stocks with at least minimum 20 price to sales ratio.
Yeah, and
most
high
expensive.
Yeah.
And
it actually would have come from that. If you had done that, it would have come from that in the past decade, but maybe not so much going forward.
I call it private public equity.
One of the things that we have on our tool is, because we're getting all the holdings of the equity ETFs, we can look at the factor exposure. So, does the ETF is it high on the value factor? Is it high on momentum? Is it high on quality? Or volatility? And, that's just a way that an investor can understand by looking at those things, what type of factor exposures they're getting by investing in that ETF. And, you have the ability to sort of search for ETFs that have certain factor exposures. Or if you're looking at an ETF and you're just wondering like, well, where does this fall from a factor exposure perspective? You kind of at least know what you're getting if you're looking at something like that. So I think that can be valuable for some investors.
Yeah. And this is to your point of what you're getting, like this is a good way to compare what the ETF says it's doing to what it's actually doing. So let's use this as an example. Like this is a price momentum ETF. Let's look at price momentum. This has a 99 score with price momentum. Clearly, this fund is doing exactly what it says it's doing. You can't have any more exposure to price momentum than it does. And also another thing you can look at is sort of the other factor exposures. And, I wouldn't recommend that as much with a momentum ETF because like we talked about before, all the rest of these exposures will change completely because momentum doesn't care about any of this. It doesn't care about value. It doesn't care about quality. It doesn't care about low volatility. So, there'll be times where momentum and value are very aligned and the value exposure is really high of a momentum ETF. And there's be times where it's the exact opposite. So this is not a good example of looking at that. But like if we were looking at a value ETF, like I might want to know, is this just an ETF that buys cheap stocks or is this an ETF that buys good quality companies at a discounted price? I would see that by looking at this quality variable. I could see in addition to having good value exposure, does it also have exposure to quality? So those are the types of things. Yeah. When you're looking at factor funds, this is really what you're getting. Your exposure to these different factors. And it's important to understand you can measure this in different ways. So we're measuring it one way here. It doesn't mean it's the only way to measure it, but I think our tool gives you a pretty good idea, like for a momentum ETF or for a value ETF, am I getting what I think I should be getting from it?
And what about the idea of the fees that you're paying for active share, which is, I know, something that we track on this page, which I think is it's kind of combining these two. Well, combining fees and active share. So if you're paying higher fees for a strategy that should be trying to look different than the market and therefore give it the potential to potentially outperform the market, you want to know that you're getting a high degree of active share for those fees. And that's a metric that we put on the page. Am I explaining that correctly, Jack?
Yeah, you are. And this gets back to what I was talking about before, which is active share is only useful when coupled with other variables. And so one of the variables is what we just talked about, which is factor exposure. So I want, like using the example I used of your two ETFs, Matt's would have had terrible factor exposure. Justin's would have had better factor exposure. So that would be good active share versus bad active share. The other place active share is really useful is when compared with fees. So like if there actually are, surprisingly enough, like 1% S&P 500 ETF fee, 1% fee S&P 500 ETFs that still exist. Those are basically giving you the same thing as the benchmark for way more money. There also are ETFs that barely change the S&P 500, but charge a high fee, what they would call like a closet index type ETF. Those, you would argue, why am I if I'm getting something very close to the benchmark, why am I paying this fee for it? And so this kind of gives you an idea of if I'm going to pay a higher fee, and you don't even have to pay, like we've talked about, a lot of these very active factor ETFs are like 30 basis points these days. You don't have to pay a high fee, but if you are paying 30 basis points instead of 10 or something, you want to understand, am I getting something that I want for that? And that's kind of what these calculations are doing, is you're basically saying, I'm getting active share. If I'm paying more, I want to pay for active share. I want to pay for factor exposure. And that's what these fee things are helping you to calculate.
So let's look at, let's continue with this momentum example. So let's look at QMOM, and we're going to compare it to the Vanguard US Momentum Factor ETF. So with QMOM, I'm just going to kind of rattle through some of the statistics. Total assets, 166 million, 39 basis points for the expense ratio, 94% active share versus the S&P. You have the fee for active share thing in here. Highest scoring metric is price momentum, as Jack pointed out earlier. We give you the issuer, Alpha Architect. We know those guys over there. We kind of create categories based on the holdings. So we're classifying this as a large cap momentum ETF. The number of holdings is 51. And then we got some liquidity, market cap and liquidity stuff. If we compare that to the Vanguard US Momentum Factor ETF, which, Vanguard is known for its lower cost ETFs and kind of broad base. So the big things that jump out at me, this isn't that big of an ETF, to be honest with you. It's 359 million. It does have a lower expense ratio of 13 basis points. The fee, the active share versus the S&P is 79. So it's certainly lower than QMOM. It also scores high based on the price momentum metric, which is what you would expect. But probably the big thing for me is the number of holdings. So with the Vanguard fund, this is holding 568 names, whereas the Alpha Architect QMOM ETF is holding 51. So you're getting much more concentrated momentum exposure in QMOM than you are the VFMO. And then there's some other statistics here as well. So, that's one way that an investor could kind of quickly compare and contrast and flip between those things and sort of just look at some of these measures to sort of figure out, what one, I guess, is best for them.
Yeah, there's no right answer here. Like I picked these two to have like a wide range of examples. So QMOM is your example of your absolutely aggressive momentum ETF, your focused momentum ETF that has tons of exposure to momentum, limited number of holdings. This is sort of the opposite, 500 holdings, still high exposure to momentum, but not as much exposure to momentum. Like we have a concentration score we calculate. I think it was for QMOM, it was like 83. And for this, it's 17. So QMOM is much more concentrated. It's just different. And neither one of these is right or wrong. Like QMOM is, if you're the aggressive momentum investor who wants the full exposure to momentum, QMOM is the right answer probably. If you're somebody behaviorally who's going to have some challenges and can't deal with the ups and downs of momentum, well, something that has 568 securities is going to give you a more watered down version. And what you want to see as an investor is what we actually do see, which is I should be going back to our discussion before. I should be paying more for QMOM. I'm getting more active share. I'm getting more factor exposure. I am paying more for QMOM. Not a lot more because they've cut their fees, but I'm paying more. I'm paying 30 basis points now for QMOM. I'm paying 16 or whatever it is, 13 basis points for this. So the right answer is, it depends on who the person is. I might be better off paying the higher fee because I want the momentum exposure. I might be better off because behaviorally I can't stick with that, paying the low fee and getting some momentum exposure and coupling it with everything else in my portfolio. It really it depends, but hopefully these are two good examples of the types of things you can analyze when you're looking at these types of things.
And it's also useful because when you do this type of analysis, you can start to say, I might want a 2.5% position in QMOM versus a 5% position in VFMO. So maybe I'm going to size these things differently back to my behavior. Maybe this is going to help me think through, like, what am I paying for in what size, and then how to build it into that broader portfolio. Tools like this help you think through what are all the different layers I can express this view of why ever I think it might be a good idea to have momentum in my mix.
And that's such an important point because people don't get that a lot. People say, like, with any kind of factor ETF, like, I want to avoid the really active high exposure ETFs because I can't handle them behaviorally. Well, position sizing can handle that to some degree. Like you said, if you may be better off having a smaller position in the very active momentum ETF than you are having a larger position, in the one that's less active. It may behaviorally maybe the exact same thing for you, but from a return profile standpoint, it might be better. So it's important not to just rule it out because something's very active. If you're somebody who can't handle the ups and downs, there's position sizing and things like that you can use to set it appropriately for your portfolio.
And that's all part of seeing stuff in the big mix, in the composite portfolio, with either these as sleeves or cores and satellites, or however you think about it in your portfolio construction process, because that takes these tools to the implementation level of, again, how is it aligned with what I'm trying to achieve for myself or the end investor? And how is the manager expressing this stuff in a way that's actually useful to me, where they are creating more value than they caused?
So let's look at two more as we wrap up here. We're going to look at the iShares MSCI USA Quality Factor ETF, and then the Invesco S&P Mid-Cap Quality ETF. Now, let's say I'm an investor and I'm looking for quality ETFs. So both of these come up because they have quality in their names, but let's look at the differences. First of all, the MSCI USA Quality ETF. I don't know this for sure. Well, because it has USA in the name, I'm guessing both of these are US centric. So let's assume that. I think that's correct. But the MSCI ETF has 35 billion in assets. It has 61% active share versus the S&P. It's by BlackRock, issued by BlackRock. It has 129 holdings. And then you got, your median. It's basically, mostly playing in the large cap space, although there may be some mid caps in there too. When you come down and look at the factor exposure, it scores very, very high in quality. And I think as an indirect, because quality has done well over the last year, it scores very high on momentum as well. And then also on this page, you can see sector and industry exposure. But when I go to the Invesco Mid-Cap Quality ETF, this is a much smaller ETF, 2.6 billion. And what should jump out here is the active share versus the S&P is 100. So this is investing solely in mid-caps. So it's looking for quality mid-caps. So you get no companies that are in the S&P are actually held in this ETF. Whereas before, in the one we just looked at, it only had 61% active share. So there was certainly a lot of overlap with the S&P 500, with the MSCI one we were looking at. And then coming down, this is by Invesco. It has 81 holdings. So this is more concentrated. And you got the median market cap, is 6.8 billion. So much, much smaller, as you would expect, because it's not holding really any large caps. But the factor exposure is somewhat the same as well. I mean, it scores pretty decent on quality and then, pretty high on momentum as well. But I would say where you would see the performance of these two things diverge is if mid caps really got hot, let's say, as a segment of the market, or if like mega cap tech, in terms of the Invesco fund, if mid caps picked up, you would see probably better performance out of that than you would if it was a mega cap growth type market. I think that the BlackRock one would probably do better, although there's still 100 holdings in there, but I would imagine that's holding like the largest stocks in the market.
This is in there because it's a great example of why it's important to look behind the scenes. So with the first ETF you looked at was what you consider more of the broader large cap quality ETF, and then the mid cap quality ETF. So using our previous example, my guess would be, you'd say, well, it would make sense that the second ETF should be the one with all the quality exposure, right? This is where we're getting aggressive. We're getting in the mid cap space. We're more focused, like we've got more quality exposure, but the first has more quality exposure, at least the way we're measuring it. But that's not necessarily a bad thing. And that's why it's important to look at these details. So if I was looking for high quality stocks, like the types of criteria we use here, and you can define quality, it's the hardest factor to define. People could debate me all day on how to define it. We've done a bunch of different things. We've got some return on capital stuff. We've got some margin stuff. We've got some consistency stuff. But if I was going to find, using the criteria you see in front of you right here, if I was going to come up with high quality companies, would more of them exist in the large cap space or would more of them exist in the small cap space? And the answer is more of them would exist in the large cap space. I mean, particularly because we're using these consistency numbers here. Like Do large cap companies have more consistent earnings? They clearly have more consistent earnings. They clearly have more consistent sales on average. So if I'm building a mid-cap quality portfolio, I'm probably using these metrics not going to be able to come up with the quality score I am with a large cap quality portfolio. And that can be different than what you see with a factor like value or something like that. So it's just important. So the point I was making is this is not a knock on the Invesco ETF. Like, this is probably a well-constructed quality ETF, but it's important to look behind the scenes and you can learn a lot about what's going on here. And in this case, the idea is if I'm restricting myself to just mid caps and I can't include large caps, I'm probably going to score lower on quality because a lot of the metrics you might use to measure quality are better for more established, consistent companies than they are in the small cap space and mid cap space.
I don't think it can be understated enough. These tools even being accessible, like this wasn't here 10 years ago. When did you guys put this tool up? How long has this been here on your website?
Years, Justin, something like that?
Yeah, maybe like 5 or 6 years, I think.
10 years ago, you had to go to the provider, pull all this data down, do your regression analysis, do all the things either independently or with like a third party that you usually had to pay for this resource. So the idea that we can even have this conversation and like pull apart this nuance with a free resource, that's democratization of investing and education in practice. That's so cool. You're just able to say what you just said, and we have a free resource to look at to do this.
We've talked about a lot. I think we've gone through a lot. If you can take a few different points out of this and, use it to select and find ETFs, that's great. If you have any questions for us, as you watch this episode, please feel free to reach out. Either you can post a comment or even reach out to us directly. Happy to talk to you. And yeah, hopefully you guys found this valuable. Thanks so much, and we'll see you next time.
Hi guys, this is Justin again. Thanks so much for tuning into this episode. You can follow Jack on Twitter at @PracticalQuant. You can follow me on Twitter at JJCarbino, and follow Matt on Twitter at @CultishCreative. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. Also, if you have any ideas for topics you'd like us to cover in the future, please email us at excessreturnspod@gmail.com. We would like this to be a listener-driven podcast and would appreciate any suggestions. Thank you.